Alright guys, in this video we will discuss about the credit spread. So when we deploy this strategy, when market IV implied volatility is high and the market is one direction or somewhere like a sideways. Alright, so in that case we deploy this strategy. When to deploy? When market is neutral to direction outlook and anticipate the asset price will move sideways or in one direction move. So in that case, we deploy this strategy. So in that case, I'm using Opstra to find out the implied volatility percentile. So here, you just go to Option and click on Dashboard. After that, you click on here, table view or title view. So first let me click anywhere like table view. So after that you can see this is sorted by implied volatility percentile. So click on here. So once we click in implied volatility percentile, so it automatically show you which stock have high implied volatility percentile. So ideally, we need more than 50 implied volatility percentile. So let me show you here. You can see first we have seen this is called Adani ENT, which have more than 50. All right, you can see this is 70. Just a minute. This is a 77 implied volatility percentile. So rest of the here you can see SEC. These two stocks have only high implied volatility right now. So in that case, we deploying this strategy in this stock only. So let me show you first what type of pattern they are forming. First, let me check it Adani ENT. So okay, here Adani ENT Enterprise. Now you can see Adani Enterprise just placing uptrend. So here you can see price was running in a sideways in this area, sideways, and finally break this range. So we expecting that Adani price will stay above this area. Okay. So in that case, we are going to deploy credit spread in Adani ENT. The strategy. Okay, let's say market is running in a sideways and price break this range, and let's say we anticipating that market will continue toward the upside. So in that case, we will sell out of the money. So here, not exactly call. Let's say we are bullish. All right. So in that case, we will sell put like here. We will sell put and we will buy. This is minus, okay, and buy a call. Sorry, put. That is the positive. Okay. So in that case, we are going to sell. In this, we are going to sell a put, and we will buy a put higher strike price with the same expiry. Okay, so means we are selling the put, that means we will collect the premium, and we are buying the put, we are protecting our risk. Let me show you in this chart. Okay, let's say this one Adani, here implied volatility high, and this is the market range. So already they broke this range, and we anticipating that market will continue toward the upside. Okay. So in that case, what we are going to do, we will select far out of the money, which delta is near about like 15 to 16. Let's go to Opstra and click here Adani ENT. and we are going to select current expiry. So in that case, we are going to, because we are bullish, so we are going to sell put. So we need at least 15 to 16 delta. So here you can see 15 to 16 delta. So this is 16, almost 17 delta. So in that case, you just select this strike price only first. Okay, so let me sell this one first. Sell. Let's say I'm showing only one lot, so based on your capital. Okay, sell another one or two strike price higher. You just buy this call to protect. Okay, so let me explain. That means this strike price, this one, we sold it, we will collect, and here we bought, we protect our position. So once we place the order, it will look like here. You can see it will look like here. Okay, so means if price stay above this area, so here we can see it's just showing break even. That means if price goes below 2087, our risk will be there. Otherwise, upper side risk free. Okay, so let's say what is the level? 2087. Go to Adani. 2087. 2087. Okay, just let me draw a line here. 2085, 86. That's 85 here. I can see. That means if price stay above this area anywhere, we will collect the premium. But if price goes down below this level, our risk will be here. All right. So later we will discuss if price goes against us, how we adjust the position. Okay. So first so when you are going to deploy this strategy, earnings should not be released before expiry. Now you can see where. So let's say we place for this month and it's going to expire on 29th June. Okay, so earnings should not be released before 29th June. So how we will check this one? So once you go to here, dashboard, now you can see this is the bell icon. So if bell icon is green, that means Adani going to release earning before the expiry. All right. So here you can see there are no green signal, green color. So that is why we confirm that Adani is not going to release earnings. So let me show you another some stocks. Is it there any stock going to release their earning? But this is not earning season right now. So that is why no stock going to release their earning. Third criteria, ask and beat not more than 0.4 to 0.5. So where you will check this ask and beat spread. Okay. So in that case, you just go to option chain. So here you can see NSE option chain website, and here you can see click on here Adani, ENT, and always check this expiry date 29th June, and where exactly we select, which strike price we select. So first strike price you can see that is 2100 put. Okay, so here 2100 put. Okay, this column you can see this is ask column and this is bid column. Okay, so means 1, 2 and third row. So in that case you can see 46 and 47. Okay, so it's almost near about 0.5, so that is why it's okay. And another we bought 200, so here you can see 3360, sorry, 3260 and 33, only 40, 0.4 spread are there. It's just perfect. Okay, so once you place this order, always say probability of profit. So basically this strategy more than 80% probability. This is the winning probability, 80%. And the next, maximum profit. So within a month, 8% is perfect, right? It's just showing like 3,000, but you always check the percentage. How much capital you deploying, how much capital you are using to deploy this strategy. So in that case, I'm using 42,000 and I'm collecting 3,400. Okay, so this almost 8% entire my capital. So it's based on like how many lot you are placing. So we are placing like 20 lot, 30 lot, like that. So based on that. Okay, and the maximum loss is showing 21,000. So if market goes down and break this our break even point, and we are not doing anything, we are not closing anything, so that but we never allow market move freely against us. So we are just adjusting. All right, so we'll hedge the delta. So later I'll discuss how to adjust this position. And always check the break even. So break even means if price goes against and cross that level, that means our loss will be there. So in that case, we have seen 2087 break even. So here I drawn this line 2087. So in case price move and break this level, this is called break even level. If break this level, so means our loss will be there. So in that case, we will adjust the position. All right, so optimal technical pattern. So basically we use this strategy, means price are breaking down from consolidation. So let's say price are running in a range. So let's say price break this area upper side. So in that case, we are using credit spread. Or let's say a price are running in a range like that and break this downside. Okay, downside. So in that case, we are using this strategy. Second criteria, we are using this strategy. Let's say price are running in a range like that. Okay. So here some confirmation are bouncing from this supporting line. This is a supporting line. So in that case, we are using this strategy toward the upper side. Okay. Or here we can see here some they are bouncing from resistance line. So in that case, we are using toward the downside. So this is the basic technical pattern, and we must know the implied volatility should be more than 50 implied volatility percentile. So we already discussed when we deploy what the certain criteria and how to deploy the strategy, how to select the strike price. Now let's say once we place the order here, so if price goes against us, so how we will adjust in that case. So let's say here, so first here you can see this is another column here, Greek. So you click on Greek. So always remember the delta. Okay, so here you can see this is the first column, this is called delta. All right, you can see here first the delta. So it's a delta almost 17, and put sell delta is 17 and put buy delta is 12. So if goes against us, so delta will increase. So in that case, if delta is increased by 15, all right, so that will be like 17 and 15, delta will 32, 32. So once a put delta become 32, and again call delta also, sorry, put sell delta will 32, and put buy also increase. So in that case, what we will do, we will close the position. We'll close the position, this position, and let's say we place here some strike price here was, and another strike price was somewhere there. All right, this is a sell, a put, and that was a buy put, let's say. So once price drop, delta will increase by 15. Increase by 15. So what we will do, we'll close this position, again reopen position, which delta is near about like 15 to 16. All right, we'll reopen, we'll sell a put, and we'll buy a put. Okay, that is the adjustment.